As Chinese President Hu Jintao and President Obama meet in Washington, investors are watching very closely, especially when the conversation turns to currencies. Jim Chanos is the founder of the more than $6 billion Kinnikos Fund and joins us now. You're also one of the most outspoken short sellers when it comes to China. So let's just clarify that position. First of all, it comes to the real estate valuations, the bubble you say there is in China. But you say we're in uncharted waters when it comes to China in terms of debt, the real estate bubble, and the 9.6% GDP growth.
Well, China is really embarked on sort of a voyage into uncharted territory as it relates to the percent of their economy that comes from investment. To put that in perspective, really the three drivers of the Chinese economy are investment, trade, and the consumer. Now, in Washington, Hu Jintao is coming to talk to the president and others about a variety of things, mostly trade. But trade only accounts net imports, in effect their current account balance, accounts for only 5% of China's economy. It's not that big because they also import a lot of things, basically for their building boom. The problem I have is in terms of the uncharted part, Poppy, is that 60+% of China's GDP is construction. China is one big construction site, and that's what's driving the economy.
So you said what worries you is seeing one high-rise go up next to another that is not even half full. I mean, the government is essentially fueling this to stimulate growth, but there's not the demand there.
Well, unlike a consumer-led economy, for example, in the States, it's 70% of our economy. In an investment-driven economy, you have to keep replacing the investment. So once you finish putting up a building, you've got to start it all over again and put up another building. And this leads, of course, anyone using common sense leads to its own set of problems.
Do you still maintain that the United States is actually sort of the most insulated from a bubble bursting in terms of Chinese real estate?
I mean, I think everybody gets affected by the Chinese real estate bubble bursting. I think the United States gets affected least of all.
Why?
Well, first of all, again, we have primarily a domestic-driven economy. We're not as dependent on exports, say, as Germany is, or the rest of Europe, or on natural resource exports like Australia, Canada, or Brazil. Those would be the economies that would be hit the most.
So what concerns you most, Jim? I mean, you've been outspoken about the level of debt in China, the amount of borrowed money in China, and you say the GDP story is not the whole story whatsoever. Why do you think that's not getting a lot of attention right now?
Well, it's interesting. In the last set of WikiLeaks, there were some cables in which apparently there was a discussion by one of the vice premiers who's coming in that he doesn't trust the Chinese GDP figures either, by the way. But here's the real problem, is that credit growth in China, pick your number, there's a couple different definitions, is somewhere between 25 and 35% of the economy. So they're expanding their credit almost 3 to 4 times as fast as they're expanding their economy. Their economy is growing 9%. So you're seeing real credit creation. And a lot of the China bulls point to the fact that individual purchasers of apartments aren't highly leveraged. But they're missing the fact that the system, which is geared toward fixed investment, is massively leveraged. A lot of companies are borrowing money to develop real estate. A lot of CEOs are surreptitiously borrowing money elsewhere to invest in real estate. There's a lot of debt in the system that's hidden in China.
This economy we're seeing in China is simply not sustainable.
I don't think it is, no.
Looking at particular sectors, I know you're short real estate, you're also short some basic commodities companies in China. Give us a little bit more on that, on companies you don't see a bright outlook for in China.
I think it's not the companies in China, it's companies in Brazil and Australia that are shipping in, the big mining companies. There's no secret as to who they are. There aren't that many of them that are really betting in many cases the companies on continued commodity price inflation for industrial commodities, iron ore, so on and so forth. And if I'm right, there's going to be a reversion to the mean for some of these industrial commodities pretty hard.
If we see the downfall of the Chinese economy, as you're betting, how big of a fall will it be? Will it be worse than this country went through in the last 3 years?
Well, to put it in perspective, in the West, at the peak of our real estate bubble back 5 years ago, investment as a percent of GDP was below 20%. It was 16 to 18%. Some of the economies like Ireland and Iceland were higher, but for the big Western economies like the UK and the US, it was in the high teens. It's going to be pushing, if 2011, if the numbers all come through as the Chinese government said, it's going to be close to 70% of their economy.